What if you could own a slice of Apple, Microsoft, and 4,000 plus other companies with just one click? No stock picking, no day trading, no stress. That's the magic of index funds. They're simple, powerful, and proven. But jargon like TER, tracking error, and market cap weighting can make them feel out of reach. In this video, BytePlain cuts through the complexity and shows you how index funds work, why they often outperform the pros, and how to pick the right one for your goals, wherever you are in the world. Let's start with the basics. What exactly is an index fund? An index fund is essentially a collection or basket of stocks or bonds structured specifically to replicate the performance of a defined market index, such as the widely recognized S&P 500 in the US, the globally inclusive FTSE All-World, or the emerging markets-focused MSCI Emerging Markets Index. When you invest in an index fund, buying even a single share immediately grants you fractional ownership of all the companies that make up that index. Unlike actively managed funds, index funds don't rely on fund managers or analysts making speculative predictions about individual stocks. Instead, these funds simply track the composition and performance of their benchmark index, providing straightforward, cost-effective, and broadly diversified market exposure without the complexity or high fees associated with active stock selection. While actively managed funds involve analysts picking stocks in an attempt to beat the market, evidence consistently shows this approach rarely succeeds. According to extensive research, including S&P's widely respected SPIVA scorecard, over 80% of active funds fail to outperform straightforward low-cost index funds across 20 years. Unlike active strategies, passive investing eliminates costly guesswork and analyst fees, letting more of your money remain invested and compounding over time. Simply put, passive funds consistently provide superior long-term results for most investors, making them a cornerstone of effective portfolio management. Understanding why passive investing often outperforms active strategies naturally leads us to examine exactly what indexes are and how they operate. An index is essentially a rules-based list of companies, chosen based on clearly defined criteria such as market capitalization, liquidity, sector, or geographical location. For instance, the widely known S&P 500 index includes the largest 500 companies in the US, ranked by market cap. Regular updates, typically quarterly, ensure indices reflect ongoing market changes, accurately representing economic shifts and company valuations. This systematic approach eliminates guesswork and subjective decision-making, which are common in actively managed funds. Now that we've explored how indexes are created, let's examine a common method used to construct them: market cap weighting. Market cap weighting assigns each company a proportion based on its total market value, calculated as the share price multiplied by the number of outstanding shares, divided by the total market capitalization of all companies in the index. Naturally, larger companies like Apple or Microsoft will occupy larger positions, whereas smaller companies receive proportionally smaller allocations. This straightforward approach not only reflects the market's actual structure, but also significantly reduces trading activity and associated costs, typically resulting in very low annual fees, often below 0.10%. Let's look at how index funds actually put that structure into action. Index funds replicate benchmarks using two main strategies: full replication, buying every stock in the index at its exact weighting, best suited for major highly liquid indices like the S&P 500. Optimized sampling, holding a carefully selected subset of index constituents when buying every stock is impractical, common with broader or emerging market indexes. Regardless of the method, the ultimate goal is the same: to minimize tracking error, the small performance gap between the fund and the index it's designed to follow. Let's consider what it costs to invest in them. The total expense ratio is a key metric. It reflects the annual cost of managing the fund, including administrative, operational, and management fees. Some of the most efficient index ETFs charge as little as 0.03% per year. However, total expense ratio isn't the only cost to watch. Bid-ask spreads and tracking differences can also quietly chip away at your returns. The lower your total investing costs, the more of your money stays invested and working for you. After understanding how costs can quietly erode returns, It's essential to explore the different types of index fund structures available, namely mutual funds versus ETFs. While both aim to mirror an index's performance, how they operate and trade can differ. Index mutual funds execute transactions only once per day, after the market closes, at the fund's net asset value. This suits long-term investors who prefer a hands-off, predictable approach. ETFs, or exchange-traded funds, on the other hand, trade on stock exchanges throughout the day, just like individual stocks. This provides more flexibility, often lower minimum investments, and in many cases, lower overall fees. ETFs also let you react to market changes in real time, although that may encourage overtrading for some. Ultimately, both vehicles track the same indexes, so the best choice depends on your personal strategy, tax considerations, and comfort with day-to-day trading. Let's talk about what they can offer at a global scale. A single global index fund gives you instant exposure to thousands of companies across major economic regions: North America, Europe, Asia, and emerging markets. This means you're not betting on the success of any one country. Historical data shows that no single nation leads the market every decade, so spreading your investments globally helps reduce risk and smooth out returns. Global diversification is one of the simplest, most powerful principles in long-term investing. Now that you've diversified globally, how you invest into those funds matters just as much as where you invest. One of the simplest and most effective methods is dollar cost averaging. This strategy involves investing a fixed amount, say $200, into index funds at regular intervals like monthly. When markets drop, you buy more shares. When they rise, you buy fewer. This approach smooths out the cost of your investments over time and helps reduce the impact of market volatility. More importantly, it keeps you investing consistently, removing the temptation to time the market and helping you build long-term wealth through discipline and routine. Beyond building wealth through regular investing, it's equally important to ensure you're keeping as much of those gains as possible. That's where tax efficiency comes in. Index funds typically have very low turnover, which means fewer taxable events like capital gains distributions. On top of that, reinvesting dividends rather than spending them helps compound your returns faster. To get the most out of this compounding, place your investments in tax-advantaged accounts whenever possible, such as IRAs in the US, TFSAs in Canada, ISAs in the UK, or CPF accounts in Singapore. These vehicles protect your earnings from taxes and can significantly accelerate your path to financial independence. Even with their strong long-term performance and efficiency, index funds still face a handful of common misconceptions. Let's clear a few of them up. Indexes are overvalued. Market timing rarely works. Valuation concerns apply to all strategies. Indexing simply removes the guesswork. Index funds create bubbles. In reality, active managers still set prices on the margin. Index funds reflect those prices rather than drive them. No flexibility. You can always allocate a small portion of your portfolio, say 5 to 10%, to thematic or tactical strategies while keeping the core indexed. So with the myths out of the way, you might be wondering, how do I actually choose the right index fund? Fortunately, the decision becomes much easier when you break it down into a few key criteria. Geographic coverage. Do you want broad global exposure? Or do you want to focus on a specific country or region? Expense ratio. Aim for funds with an expense ratio under 0.15% to keep more of your returns. Fund size and liquidity. Larger funds generally track indexes better and are easier to trade. Tax efficiency. For international investors, Ireland-domiciled ETFs can offer more favorable tax treatment. Dividend strategy. Decide whether you want income through distribution or automatic reinvestment via accumulation. By evaluating these elements based on your goals and location, you'll be able to pick an index fund that works for your strategy and maximizes long-term gains. Now that you know how to choose the right fund, let's wrap up with the key takeaway. Index funds give you instant diversification, ultra-low fees, and performance that consistently mirrors the market. When paired with consistent investing and low costs, the power of compounding can truly take over. So, start today. Pick your fund, automate your contributions, and stay the course. Share which index fund you're using or planning to use in the comments below. If you found this helpful, like the video and subscribe to BytePlain. And of course, this video is educational. Always speak with a licensed financial advisor before making investment decisions.